Our guest says the next wave of Fed cuts has already been priced into the market largely. Let's get more from Scott Chronert, U.S. equity strategist at Citi. Thanks very much, Scott, for giving us the time this morning. Obviously, the market near record highs, and you think a lot of this is more interest rate reductions are baked in already.
Yeah, Andrew, I think that's more or less the case. If you look at where Fed funds is here in the U.S. relative to where two-year treasuries are, I think the market's been telling us for some time now that this expectation for the Fed to continue to glide interest rates lower has been pretty well identified and discounted, certainly in U.S. equities for sure.
Do you feel, I mean, I know we could parse this all day, and I'm sure the AIs have been having a go at it, but do you think it was something of a hawkish cut by the Fed yesterday in the sense that they did refer to persistent inflation?
You know, I'm going to turn that discussion around. I think I actually viewed it as a bit more dovish, if you will, because I think what has been fairly clear coming out of at least Chairman Powell since the Jackson Hole meetings back in August is that the concern about ongoing economic weakness is certainly front and center for them. And then additionally, most of the commentary around tariff impacts on the inflation setup here in the U.S. are being construed as more transitory or one-off, if you will. So where we're looking at this, the announcement and the commentary yesterday is a little bit more biased down the path that, hey, there certainly is something in terms of economic unwind or deceleration that is certainly front and center for the Fed governors.
Let's have a look at at the S&P 500 futures again, because they are pointing to a modestly higher open. So we have an S&P at around 6,600, and that was your year-end target for the index?
That's correct. So, yeah, we've been sort of persistently positive on the S&P as the years unfolded. But like I said, like you're pointing out here, with this latest move up, we bumped into our 6,600 target. Our point here being is that we think this more or less reflects something we'd consider fair value for the S&P. Doesn't mean you can't run higher, but what I would suggest is that it reinforces our perspective that with the valuation circumstance for U.S. equities as it is, with the growth expectations from a fundamental perspective that we think are increasingly being reflected in that valuation, essentially what you're looking at here is a little bit more of a sentiment playbook than probably a distinct fundamental playbook. Now, structurally, we remain quite constructive on the S&P 500 longer term, but I'd say in the short or intermediate term, we're preparing ourselves for a bit more volatility, Andrew, as we go into the Q3 reporting period now.
Many years ago, I bought a girlfriend a nice purse for a birthday present, and my buddy said, you know, Andrew, she's going to have high expectations from now on. Why am I telling you this story? You think investors are going to have high expectations? The bar is going to be high for the next while?
Yeah, so the way we're thinking about it is that the Q2 earnings reporting period was very robust. Companies gave you very strong beats. In many cases, were raising full year expectations. We think some of that sentiment is shifted over, and that expectation is there again for the Q3 reporting period. That is what we're kind of getting at from a fine-tuning perspective. That's our concern, is that you go into the Q3 reporting period, you get very solid earnings, but you may not get that beat and raise that's really kind of fulfilling where current expectations are, to your earlier analogy. It's not bad news. What it essentially does is just prepare us that we have to expect a little bit more of a volatile dynamic for the S&P as we go into the reporting period. But then as you get further into the year, closer to year end, you get that next second and or third Fed rate cut. Now you begin to set up for a more traditional year-end rally in anticipation of something for heading into 2026 that looks more like an early cycle playbook. And that, we think, ends up being constructive. It's just kind of navigating how much is being paid forward for some of the Fed expectations currently.
And the AI spend, we know that hundreds of billions have been announced anyway. Presumably, though, if there is distinctive evidence of a slowdown there, that will hurt the market.
So that would be the example, right? So when we look at the S&P 500 as an example of the market, our work is that roughly half of the index is associated with this AI theme, okay? That gives you the other half that's beating to a more traditional economic sensitive drummer. So yeah, in terms of looking at that AI influence, the market has gotten very comfortable that you're seeing this ongoing investment phase, which we think will continue. The question is, do you continue to see the CapEx expectations ratchet higher and higher and higher? There's some point where we think that the current spending plans get you to where you need to be in terms of ultimate AI adoption. So it's just trying to, if you will, sort of assess where you think investor expectations are versus fundamental reality, which we think is still very, very robust and should be for the next several years.
When you talk to clients, is there something that they're saying these days that you think, oh, that's new, or I haven't heard that for a few years, or anything that surprises you these days?
You know, I'd say that client conversations are pretty straightforward. When you sit in a strategist seat like mine, it's really interesting when the market's up and hitting new highs. They don't need to talk to you quite as much. It's usually when things are under duress where, hey, we need some perspective on this. So I'd say what's happening right now is that investors, certainly as we get 3 quarters into the year, are more or less in a glide path now into the year end. So the discussions begin to shift towards the 2026 setup a little bit more than how you think we're going to finish the year. Generally speaking, I'd say that the growth mantra continues very robust and front and center in investors' minds. The question becomes, how quickly or how broadly do you think about this aspect of the market moving down other sectors than just the AI influence, maybe other geographies, and then even down cap into small mid cap? Those are where the broadening discussions are taking us more recently.
Thank you so much for giving us this time today, Scott Chronert, U.S. equity strategist at Citi.